Have you ever wondered why the bank's loan amount is different than what you model? Hey ladies and gents, welcome to another episode today of Creative Real Estate's educational content pieces. I hope that you're going to love this one. Have you ever wondered why the bank's loan amount is different than what you model? It's not random. You see, lenders look at the deal through a different lens. They focus on what your property earns today, not on what it might earn tomorrow. And once you understand how they think, you can predict with confidence what your proceeds should be even before you receive the term sheets. When sizing a US loan, lenders typically focus on three main checks: debt service coverage ratio, the debt yield, and the loan to value. These tests typically tell them if the property generates enough income to safely repay the debt and if the leverage fits their policy. The smallest result of these three will usually determine your maximum loan amount. Let's start off with looking at debt yield. So your debt yield is essentially your net operating income divided by the loan amount. You could kind of think of it as the lender's cap rate. Instead of dividing by the purchase price of the property, you're just dividing it by their loan value. Debt yield shows the lender how much income the property makes for every dollar that the bank lends. It's like the lender's return on loan amount, or like their cap rate, as I mentioned. The higher the yield, essentially, the safer the deal. If a property earns $1 million and the loan is $10 million, then the debt yield would essentially be 10%. Typical ranges for debt yield can be anywhere between 8 and 12%, depending on how stabilized the deal is, or if there's a bit of a transition and higher risk inside of the deal. Why it matters and is special is because debt yield is independent of interest rates or amortization. So it's a clean way to really compare risks between deals, irrespective of whether the amortization period or interest rates differ. Okay, the next metric, number 2, is the debt service coverage ratio. This typically measures how easy it is for property's income to cover its debt obligation. A DSCR of 1.25 times essentially means that the property earns 25% more than needed to pay the loan each year. The DSCR measures how easily the property's income can cover its debt service payments. You see, it's calculated as the NOI divided by the annual loan payments, including both principal and interest. An example would be a debt service coverage ratio of 1.25x. That would be calculated as the NOI of $1 million, and assuming that the debt service payments, including interest and principal, work out to $800,000. Typical thresholds for debt service coverage ratios can be anywhere between 1.15 times all the way up to 1.4 times, depending on the lender, who they are, and the risk inside of the deal. A DSCR of 1.25x essentially means that the property earns 25% more than it would need to cover its debt obligations. You can see this illustrated really beautifully here on the chart. Another point that I wanted to bring up, or a metric that I like to track that isn't necessarily one of the top three, is the debt constant. And essentially this tells us how much of every borrowed dollar you pay each year, including both interest and principal. You see, at a 6% interest rate and an amortization over 30 years, the annual payment per dollar of loan is roughly 7.265%, or 7.265 cents on every $100 that you owe. The reason I personally enjoy using this as a metric is that it allows me to compare it against my cap rate. And if I assume that I borrowed 100% of my purchase price, I would have an indication of if the cap rate is higher than the debt constant, that the property would still cash flow. If the property's cap rate was below the debt constant, it definitely wouldn't cash flow with 100% leverage. And I love using that as a quick gauge to be able to figure out whether or not the property would still be able to push out cash flow, even if it's servicing its debt payments with principal. All right, the third metric that they like to look at is the loan to value. Loan to value compares essentially the property's value with the amount that they are loaning. So the loan to value compares the loan to the property value. It's calculated as the loan amount divided by the fair market value of the property. Or typically it would be calculated on your purchase price, which should be the fair market value of the property. An example would be if you're getting a loan of $10 million and you bought the property for $15 million, the loan to value would work out to 67%. Typical thresholds could be anywhere from as low as 50% all the way up to an 80% loan to value. However, typically speaking, for a stabilized asset, it'll be anywhere between 70 and 75%. Okay, now we're going to put it all into practice based on three metrics which we're going to create. First of all, the debt service coverage ratio needs to be 1.3 times. The loan to value needs to be at least 70%, and the debt yield must be at least 10%. Let's hop into a spreadsheet just to run through this quick. All right, here we have a deal of $15 million. It's a 5-year hold, 5.5% cap rate, and there's 100 units theoretically that we're considering. The maximum loan to value, as we said, should be 70%. The debt service coverage ratio 1.3 times. The minimum debt yield 10%. Okay, the loan is going to be a 6% interest rate, amortized over 30 years with a 5-year term, and we're going to do 0 years interest only, or months. Let's take a look at how this plays out. What you'll see here is our net operating income is about $1,009,000. Couldn't get it to $1 million on the mark because this is from a real model that we've used on another deal that we just edited, and my analyst clearly had a hard time getting it to $1 million. So for today, we're going to be using $1,009,000. All right, as we walk through this, what you'll see is we have an interest payment of $602, a principal payment of $123, and we have free cash flow available thereafter of $283,000. This essentially works out to us having a debt service coverage ratio of 1.39 times based on our NOI and our debt payments annually. As you can see, 1.39 is above the required 1.3. So this wouldn't be the metric that's going to limit our loan. You'll see it is shown as okay. In fact, if we were to work with the maximum loan amount at 1.3 times based on where our NOI is, our loan will come out to $10.684 million. If we look at the next metric, which is our loan to value, what we'll see over here is at a 70% loan to value, we could use a loan of $10.5 million based on the $15 million purchase price. And our final metric is based on the debt yield, which, as you'll recall, is essentially the net operating income divided by the percentage of the debt yield that they require, which in this case is 10%. So because we have a net operating income of $10,009,000, our maximum loan amount per the debt yield is going to be $10.090 million. So what I want you to pay attention to is these are the maximum loan amounts that we would be able to achieve on any given one of these metrics. However, you need to remember that the maximum loan amount that we're going to get is going to be on the smallest loan amount available based on these three metrics. In this case, that happens to be the debt yield. So you'll see our new loan to value based on this loan amount, the debt yield loan amount is 67.3%. Our DSCR remains constant at the 1.39, and our debt yield is now officially 10%. I want to mess around with some of these variables just to show you how it would affect which metric is going to come out to be the limiting factor. So currently it is our debt yield that's the problem. So what I'm going to do is reduce that requirement. So let's assume that the lender's debt yield requirement is not 10%, but it's actually 9%. What you'll see over there is that the maximum loan proceeds on a 9% debt yield work out to $11.2 million. So now we're suddenly limited by the loan to value. But what if the lender's maximum loan to value wasn't 70%, it was 75%? Suddenly what we'll be limited on is the debt service coverage ratio. Now the debt service coverage ratio, maximum loan amount, is 10.684. So you can see how these metrics all start to get pretty tight. And we still currently meet the requirement at the 1.31 times. If we were to make the requirement 1.4 times, you can see how our loan proceeds come substantially lower. So we drop completely off a cliff here relative to the other loan amounts. Another way to do this, and this is where interest rates become incredibly important, is if we were to leave it at 1.3 times, but our interest rates went down to 5%. You can see how that affects everything. The interest rate on our loan amount at 5% affects the loan proceeds to go to $11.93 million. That's a big jump. 6%, 10.684, 5% gets us to 11.932. I hope that through looking at this model, all of the pennies are kind of dropped and you've got a much better understanding of how the varying factors and requirements by the lender can affect your final loan proceeds. Finally, I want to spend a minute on the borrower factor. So even with perfect numbers, who the borrower is really still matters. Lenders look hard at the sponsor's experience, balance sheets, and their existing schedule of real estate owned. Strong, well-capitalized borrowers with lots of experience will often get better proceeds, lower spreads, and smoother approvals in place. Even for non-recourse loans, your financials and track record can really move the needle. In today's market, experience can be the difference between getting 70% or 60% leverage. So to sum it all up, why are bank loan offers often lower than expected? It's because lenders typically use real in-place income and their risk rules, not your future projections. They also weigh your experience and your financial strength heavily. When a property's future income is expected to be much higher than its current income, it may not make sense to get a permanent debt right away. Permanent loans are priced and sized on the income you have today. In those cases, many lenders actually choose to rather take out short-term or bridge debt so that they can get way more proceeds based on what the pro forma looks like in future. However, this does come with a trade-off of taking on additional risk, and that typically comes with a high interest rate, and the lender will also oftentimes require recourse. We'll cover this in more detail in the next video. And let's bring it all together. When you know how debt yield, debt service coverage ratio, and loan to value work, as well as how your borrower's profile and your income on the property side story factor in, you can forecast proceeds with confidence. Lenders will rarely deviate wildly. The biggest gap usually lies in your assumptions. Your assumptions on the future income, your assumptions on how good your profile is, and your assumptions on what their metrics are. If you enjoyed this video and found it valuable, hit the like and subscribe button below. I would love to hear back from you if you think we need more detail or less detail in these videos. Thanks again for your time. Have a fantastic day. Cheers.